Good morning. Thank you for joining our webinar on changes in pension scheme investment compliance and disclosure requirements. I'm Edward Jewitt from the Pensions Group at Mayor Brown, and our guest speaker is Erik Davey, Director of UK and Europe at SECOR Asset Management. Good morning, Erik.
Morning, Edward. Happy to be here and look forward to the discussion.
In today's webinar, we look at new requirements to prepare investment implementation statements and to make compliance reports to the Competition and Markets Authority. We then look at proposed new requirements for governance and disclosure of climate-related risks. Trustees of most defined benefit and defined contribution schemes will need to include an implementation statement in their first annual report, which is finalized after the 1st of October this year. Implementation statements have to be prepared by all pension schemes which prepare statements of investment principles. That means broadly all schemes with at least 100 members. The implementation statement needs to cover different things depending on whether your scheme is a defined benefit scheme or a defined contribution scheme. And when we refer to a defined benefit scheme, we include schemes which are predominantly defined benefit, but which also provide money purchase voluntary contribution benefits. For defined benefit schemes, the implementation statement must set out how the trustees have followed the part of their statement of investment principles which deals with the exercise of rights attaching to investments, including voting rights, and the undertaking of engagement activities. The implementation statement must also describe voting behavior, including the most significant votes cast during the year covered by the annual report, and also state the use of the services of a proxy voter during that year. So for defined benefit schemes, the implementation statement deals with the exercise of rights attaching to investments and engagement activities, and with voting behavior. For defined contribution schemes, the implementation statement is broader. It must set out how and the extent to which the whole statement of investment principles has been followed during the year covered by the annual report. It must describe any review of and changes to the statement of investment principles which was carried out during the year, and if there was no review during the year, say when the last review was carried out. And finally, as for defined benefit schemes, the statement for a defined contribution scheme should describe voting behavior, including the most significant votes cast, and state the use of the services of a proxy voter during the year. The implementation statement must form part of the first annual report to be finalized after the 1st of October 2020, and a copy of the statement needs to be published on a publicly available website with effect from the 1st of October 2021, if you're a defined benefit scheme, or from the date the annual report containing the statement is finalized, if you're a defined contribution scheme. And the pensions regulator has a power to impose civil penalties for non-compliance of up to £5,000 for individual trustees and £50,000 for trustee companies. Erik.
Hi, Edward. That was a very helpful summary. I did notice in there that you mentioned in relation to implementation statements for DC schemes that trustees will need to disclose when the SIP was last reviewed. What if there's a situation where the SIP was not reviewed within the past year? Is there anything that trustees should be careful about when disclosing this?
Yes, the thing to watch out for there is that regulations require the statement of investment principles to be reviewed at least every 3 years and without delay if there has been a significant change in investment policy. And it's sensible to check that you've complied with that requirement so that you don't have to report a compliance failure.
Okay, great. That's very helpful to know. In terms of our perspective from SECOR Asset Management, one of the things we've been looking at this is kind of what the different elements of the implementation statements are. I have to say for us, our work to date has primarily been focused on the DB side, but we have noted there's a number of more straightforward elements to the implementation statement, such as the extent to which you feel the statement has been followed during the year, recording any changes to the SIP and what the rationale for that is. Some of the other items, and I think it'll vary by plan, may be a little bit more complex and entail a little bit more work. Things such as the exercising of rights, including voting, may be more complicated. And what we've been advising our clients, and we think the right thing to do, is to just get started on it early and make sure that you have a plan. You want to identify any gaps in terms of available information. You want to understand what your specific deadlines are. As Edward mentioned earlier, this is for reporting for plans after 1 October, but it's not the same for every plan. So understanding those deadlines, understanding the service providers you'll need to work with, we think those are critical elements to making sure you have a successful completion of your implementation statement. I think it's also to note that you need to have very relevant and useful information in this report so that it can be consumed properly by the stakeholders. I think in the past we've seen some regulation that may be more tick-the-box oriented, but I think the implementation statement requirements and what the regulator is expecting here is more detail. So again, the most important thing we're sharing with our plans is our clients is to have an early think about it, make sure you have a game plan, make sure you know who you need to interact with, and we think this will hopefully go smoothly for all involved.
Moving on to Competition and Markets Authority compliance statements, any pension scheme which uses a fiduciary manager or an investment consultant will need to send a compliance statement to the Competition and Markets Authority by the 7th of January 2021. The background here is that on the 10th of June 2019, the Competition and Markets Authority made an order that requires a tender exercise if a new appointment is made of a fiduciary manager for 20% or more of your scheme's assets, and a tender exercise within 5 years of first appointment, where, on the 10th of June 2019, a fiduciary manager had already been appointed for 20% or more of the scheme's assets without a tender exercise. The Competition and Market Authority order also requires that strategic objectives should be set for investment consultants. A compliance statement is supposed to confirm the extent to which the relevant parts of the Competition and Markets Authority's order have been complied with, and it has to be signed by the chair of the trustees or any trustee director where you have a sole corporate trustee. It was intended that the Competition and Markets Authority order would be replaced by DWP legislation, and that compliance reports would be made to the pensions regulator rather than the Competition and Markets Authority. But the government has been busy this year, and so this has not happened. Erik, any comments you would like to make?
Yeah, Edward, there's not too much to add to this, really. As you mentioned, the expectation is we wouldn't be required to report to the CMA. However, it's worked out such that we have to. So, what we're sharing with our clients is just be sure that you fill in the statement as prescribed by the CMA. It is our understanding that the CMA has provided a template that plans can work off of in terms of completing that. And quite frankly, hopefully, if everybody's been working with their advisor over the past year and understands what's required of the CMA order, our expectation is that this should be relatively straightforward.
The government has proposed new governance and disclosure requirements for climate-related risks. If these become law, they will apply to schemes with assets of £1 billion or more and to authorised master trusts. Schemes will be required to publish an annual report covering how they have complied on a publicly accessible website. And some of the concepts which trustees will have to address in this annual report will be covering new ground for many of our clients. To set the scene, an international agreement on climate change was reached in Paris in 2015. This aims to ensure that the increase in average temperatures compared to pre-industrial levels is kept to well below 2 degrees centigrade by 2100, and that efforts are made to limit the temperature increase to 1.5 degrees centigrade. Government action will be needed to achieve this, and this action may have significant impacts on companies as they are required to change the way they operate. According to the government, the International Monetary Fund has identified that stock prices do not fully reflect two types of climate risk: transition risk, which is where companies and their assets become less valuable because of new rules designed to prevent climate change. For example, If laws were to change in line with the Paris Agreement, then consumption of fossil fuels would be restricted, and this could lead to changes in the value of investments held in sectors like oil and gas. And there's also physical risk, which is the risk of more frequent or severe weather events like flooding, drought, and storms. And the government is therefore proposing new governance and reporting requirements in relation to these climate-related risks. The government's proposals draw on recommendations of the Task Force on Climate-Related Financial Disclosures. This is a group chaired by Michael Bloomberg, who published recommendations for how companies and investors, including pension schemes, can produce information on the financial impacts of climate change in a standardized way. So what are the proposed new governance and reporting requirements? In the interest of time, I'll just pick 4. On governance, trustees should establish and maintain arrangements for oversight of climate-related risks and opportunities, and establish processes for checking that persons managing the scheme are assessing and managing climate-related risks and opportunities. So in other words, the trustee board should decide who's responsible for overseeing climate risks and opportunities and establish processes to check that those risks and opportunities are taken into account by asset managers and others involved in the running of the scheme. And the government expects trustees to disclose these oversight arrangements as part of an annual climate risks disclosure report. Trustees will also be expected to carry out scenario analysis. At least once a year, trustees should assess the resilience of their scheme to climate-related risks in at least 2 climate-related scenarios. And one of those scenarios should assume an eventual global average temperature rise of between 1.5 and 2 degrees centigrade compared to pre-industrial levels. And trustees will then be expected to report on the result of this scenario analysis in their annual climate risks disclosure report. Statutory guidance will set out what trustees will be expected to do in this analysis, including how you're supposed to deal with lack of available data. Trustees are expected to assess their scheme against at least 2 climate-related metrics, systems of measurement. Trustees should choose at least one greenhouse gas emissions metric and at least one other non-emissions-based metric to assess scheme assets against climate-related risks and opportunities. Assessment against the chosen metrics should happen at least quarterly, and the metrics are supposed to be disclosed in the annual climate risks report. Again, there'll be statutory guidance to help with this, and this is expected to say that the trustees should choose weighted average carbon intensity as their emissions-based metric. This is a metric for measuring a scheme's exposure to carbon, expressed in tons of CO2 per millions of dollars of revenue. And finally, trustees should set targets. There should be at least one target to manage climate-related risks for one of the metrics that the trustees have calculated. And they should disclose performance against that metric annually in a climate risks report. In terms of timing, if this becomes law, it will be brought in 2 stages. For schemes with $5 billion or more of assets, and also authorized master trusts, the governance requirements would apply from the 1st of October 2021. Disclosure requirements would require publication of a climate risks report within 7 months of the end of the scheme year, which is underway on the 1st of October 2021, subject to a hard deadline of the 31st of December 2022. So if you have a 31st of March year-end date and your scheme is more than £5 billion of assets, then your first annual climate risks report would be required by the 31st of October 2022. The requirements would apply a year later for schemes with $1 billion or more of assets. It's uncertain whether the requirements will apply at all for smaller schemes with assets of under £1 billion, and there would need to be a further consultation before that happens. It's proposed that the pensions regulator should have powers to issue a civil penalty for non-compliance. The maximum penalty would be £5,000 for an individual trustee or £50,000 for a corporate trustee. The penalty would not be mandatory except for wholesale non-compliance, in other words, where trustees have not published a climate risk disclosure report at all. Erik, your thoughts?
Yeah, Edward. Well, I did have one question on what you shared with us, and it was a very helpful summary, so thank you for that. In terms of the climate risk disclosure report needing to be published on a website, why do you think that's the case?
Well, there seem to be 2 main reasons to require the climate risk disclosure report to be published on a website. And the first is to enable members to engage with trustees of their schemes about climate change issues. And the second is so that schemes can learn from one another. I also suppose that making the report publicly available means that anyone, including pressure groups, will be able to see it, which introduces an additional element of risk into trustees' work.
Okay, yeah, that makes sense. Very helpful.
Given that this is all new, Erik, how in practice would you expect schemes to comply with these requirements in the first year?
Yeah, Edward, I think that's an excellent question, and probably a question that a lot of us are asking ourselves. As you mentioned, this is a relatively newly published consultation. There is a good amount of information available, but it has not yet been put into legislation. So in reality, we're still thinking through really what this may entail. Our understanding in speaking to colleagues in the industry and our own research and speaking to folks such as yourself is there will be a cost associated with this in the first year. The working group is estimating that it could be around £15,000 per plan and a considerable allocation of resources as well. Others are saying it may be more expensive, and depending on what level of reporting you want to do, could consume, some considerable resources. So this certainly isn't a tick-the-box exercise. Once this comes into legislation and we have more clarity, the expectation is the reporting will be significant. In terms of how the industry is going to deal with that, we think some advisors are working on developing an in-house capability there. We also know that there are a number of different data and analytic providers that cover these types of analyses for plans in the market. So likely what plans will need to do is go out and leverage either their advisors' in-house capability or perhaps supplement that with some of the external providers. I think until we get a little more clarity on exactly what the reporting requirements are going to be in the legislation, we're a bit in a wait-and-see mode. But I do have to say it's fairly clear that the general movement and direction of regulation and law, particularly around climate change, is moving in one direction, and it's likely more and not less. So we think it is worthwhile for folks to try to get up ahead of this, start to think about what the requirements may be, understand the material that's been distributed from the working group, and I think, Edward, the summary that you provided is very useful in terms of getting folks started on that. I think if folks haven't already, one of the things they can do early on, as you alluded to, is understand and document who is responsible for overseeing climate risk and opportunities in your plan. This will likely involve engagement with your asset managers, so engaging with them to understand where that responsibility lies and whether it's been delegated, I think is very important. As for SECOR, we have actually over the past 3 years on behalf of our clients been surveying all of our external asset managers to understand exactly how they address climate change and ESG related matters. So again, we've had the opportunity to engage with them previously, but for those folks who maybe haven't, we'd certainly suggest getting started on that. And I think a number of people will probably look at this and say, well, there's not much I can do as an individual plan, or the impact won't be that robust. But once industry-wide pressure is applied and asset managers who are responsible for making the investments understand what the goal of the asset owners are, particularly in terms of complying with upcoming legislation, that soft pressure collectively has an impact on the managers and the industry, and in terms of providing the transparency and clarity that really this legislation is geared towards. So again, early days, so we don't have any kind of definitive action plan. We're digesting it as many others are, but it's certainly worth starting to think about now and having a good game plan in place.
Thanks very much, Erik. Well, that's all from us. If you have any questions, do feel free to email Erik or I using the details on this last slide. And thank you very much for joining. Goodbye.